Since 1955, or nearly 3/4 of a century, the US has had 10 recessions in that time. In all 10 recessions, the stock market bottomed during the recession and before the end of the recession. And I will show you that momentarily. In all 10 of those recessions, the stock market bottomed as interest rates were declining, not increasing or holding at current levels. And as many of you know, we are currently increasing. We are not declining on interest rates. Okay? Since 2008 until 2022, a span of 14 years, the quantitative easing program has gone from 1 trillion in 2008 to 9 trillion in 2022, a 900% increase. Quantitative easing, as you know, represents bonds and mortgage-backed security purchases by the federal government that I will show you momentarily, propped up the stock markets in the last 14 years artificially. Okay? It is the interest rates and the quantitative easing that the Fed has been doing the last effectively 20 years, has propped up the stock market and has single-handedly elevated, skyrocketed inflation. Okay, and now they have to undo it all. And I will show you the lockstep correlation that what the Fed has been doing the last 20 years and what they are doing now to undo it, and the stock market's lockstep movement with what the Fed is doing with interest rates and quantitative easing. So stick around for part 2 of the Nowhere Near Bottom series. It is at the very least going to raise at least one eyebrow. Okay, so, but before we get into part 2, just note that, well, there must have been a part 1, and that was released 2 weeks ago, so I encourage you to watch that. Part 1 was really about the quantitative side of where I thought the market bottom is going to be, which I will go ahead and spoil it for you. It is, I believe, to be August 5th, 2024. Okay, so please check out the quantitative analysis that I did, how I came up with that date. Today, however, will be qualitative to the right in part 2, and we are going to look at the interest rates and the quantitative easing programs that the Fed has been doing for the last 20 years. Now, let's first start off with the quantitative easing. Okay, let's get to the kind of the macro stuff first. I'm going to cite my sources for you guys. Okay, many of you are probably familiar with Fred. That is the St. Louis Fed, and there's the website by which I got the total assets, which represents the bonds and mortgage-backed security purchases. Okay, that's the website. And now let's start from the left, from the beginning. And the bottom represents the stock market movement. Okay, let's talk high level for a minute. Let's just talk high level. Look at the bottom down here, the stock market, how it moves. And do you see the blue line up here with the mortgage-backed securities? Well, the total assets, mortgage-backed securities and bond purchases since the last 20 years. Look at the movement. And look at this hyperbolic movement in the last 2 years up here. And look at this hyperbolic movement in the last 2 years down here. See that? They move in lockstep, the movement between the total assets and the stock market performance. Okay? That is undeniable, the correlation in the movement. All right? Okay. Now that I've pointed that out, let's kind of zoom in a little bit and let's get to 2003 to 2008. For 5 years, effectively it was pretty stable. See that? Pretty much right around, I'm going to say starting in 2003, it started around 750 million. And we'll just call it for the sake of discussion. By 2008, it's close to one, but let's just call it one, right, for the sake of discussion. Okay. I note that it's interesting because in the first video, the first nowhere near bottom video where I used the dot-com bottom, that was September 2002. QE started January 2003. I find that peculiar in terms of timing. That, oh, okay, the dot-com finally has bottomed, in September 2002. A couple months later, we're gonna start this. But like I said, it started from 750 million, and it ended up close to one. So I would say that's not a huge jump. Okay. Now, um, note that slight gradual incline there, and the markets still, but this is due to primarily, honestly, it still started to fade down here towards the bottom, towards 2008. Well, that was because of the whole Lehman Brothers and all the fraud and all the credit default swaps. We all know the whole story there with the great financial crisis. Okay, but look, notice something. The markets bottomed right here. It was March of '09. We all remember that, right? Right here. This is the red line. Look at where the bottom is in the markets. And look at where that bottom is relative to the whole recession. That's this vertical gray bar. It's towards the end of the recession. Okay? And look at how the bottom, despite the Fed jumping in and turning on the money printers right here, we went from 1 to 2 million in like 2 months. Okay, it took 5 years to stay at one, but then we went from 1 to 2 in like 2 months. Okay, it may be a little bit longer, but you get the idea. It was fast. We doubled in, we'll just say 3 months. We doubled in 3 months what it took 5 years to do. Okay, but despite the sharp rise, $1 trillion in 3 months, markets kept going down. Okay, so I want you to keep that in mind that if we have a black swan event where something forces the Fed to pivot on the spot to turn the money printers back on, let's just say tomorrow, Monday, okay, the markets are still going to go down. That's happened time and time again, and I'll show you multiple examples of this, especially when we get to like on the interest rates screen. For now, we are on the quantitative easing discussion. Okay, we're not going to talk about interest rates yet. This blue line here is strictly the quantitative easing. Okay, bonds, mortgage-backed security purchases. Okay, so we all know what happened in 2008, but you know from 2008 to 2020, right? This is this red line here. We went from 1 trillion, 4 trillion. Okay, that's a 400% increase. Okay, and then correspondingly, you see, look at that. Oh well, the stock market sure did go up, didn't it? Now, everybody knows this is 2020, and from 2020, we added another 4 trillion. Okay, so okay, the here, let me show you this press release. Here, let's zoom on in so you can see my source. I took it straight from the federal government's website. Okay, their website. What they are saying here, many of you probably already know, is with respect to this downward curve right here. They are reducing the size of the Federal Reserve's balance sheet, totaling 95 billion a month, moving off the balance sheets, just letting it expire. Don't buy any more. 60 billion in treasuries, 35 billion in mortgage-backed securities. That's 60 billion, that's 35 billion. Okay, if you want to read more about that. The goal is to get it down to pre-pandemic levels. Erase 5 trillion. That's the goal. Whether we're going to get there or not is a different question. Okay? The goal is to get to this level again. Okay? How and when and how fast? That's anybody's guess. Okay? But I want you to look one more time. Look at this. Look at the parabolic move and look at the move down. Look at the parabolic move and look at the move down. The markets are not able to readjust to the new world where it's no longer easy money. Interest rates are not going back to zero. In fact, as you and I know, interest rates are going up. In a couple of weeks, we're going to be getting another 50 basis, right? A 50 basis point hike. And then they're talking about potentially in February, when they meet again, another 25 or more. Depends, just depends on the CPI, upcoming CPIs. Okay. So there you have it. I just want to say I put Ben Bernanke here because by all intents and purposes, he is the father of quantitative easing. Okay. And I put his picture up here because I find there is a twist of irony that the very person who wins the Nobel Prize in economics is the very father of engineering, the greatest bubble of all time. I'm referring to this parabolic move up, and that it's all going to be coming down. So I find that with a twist of irony that he gets the award for engineering what will be the greatest bubble burst of all time. Okay? Now let's move over to the more interesting discussion of interest rates. Okay. Once again, let's get to my sources. Okay, this down here is the historical chart, macrotrends.net, of the S&P 500. Okay, so I got it from here. This is what you're looking at. Since 1950 until today, the chart for the S&P 500. So this smaller chart is what is represented by this bigger chart right here. Okay. Up top we have once again the Fed website. And this one is the federal funds effective rate. The previous screen that you saw was about the mortgage-backed security, the total assets, right? Total assets, bonds, and mortgage-backed securities. This one is about the federal funds rate. That's what everyone loves to talk about in 2022, right? Okay. So those are my sources. Let's get into it. Let's just start from 1950, 55. 55. Let's see here. Okay, so let me see if I can zoom out enough, but not too far. All right, 1955-ish to 1960. Here's the market bottom, and here's the market bottom. This was the federal funds rate. At the time, the market bottomed. I drew this arrow so it's easy to see, right? So you don't have to eyeball it. Federal funds rate when the market bottomed because the markets were crashing, forcing the Fed to pivot from up here down here, okay? So that's what I say. At no time since 1955 has the market bottomed while the Fed is still increasing rates, right? That's what I want you to see. So I'm showing it to you, right? So here's two examples of that. Let's check this out. 1970, getting close to the Paul Volcker. I think it was Paul Volcker actually during that time. Market bottoms right here down below, 1970-ish. That's where interest rates were. They're falling, not increasing, and not holding. They're falling because okay, by the time the Feds are forced to pivot and cut rates, it's too late. The markets are already crashing. and they will continue to crash for a period of time. Okay, so so just keep that in mind. That just because we have a black swan event, and then all of a sudden Monday the Fed say, okay, we're going to cut rate. Currently it's sitting at 4%. We're going to cut it down to 2%. Like, right? Let's just say, like in this example, it's too late. The markets will keep crashing. If the markets won't be like, oh, okay, on Tuesday, here we go, V shape, we're going back up. Oh no, 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 no. We are going to keep falling even after the pivot. Okay, that's 1970. That's 1975. Oh yeah, this. Yeah, this is crazy. This is Paul Volcker era here. Okay, okay. Let's check this out. 1975. Market bottoms here. Where were interest rates at market bottom? Right around here. Falling, not rising, not rising, falling. Okay, okay. 1980. Good old Ronald Reagan. So this was the Paul Volcker era in the 70s. Market bottoms. Let's go up here and see why. Oh, it bottoms because a sharp decrease in interest rates back down towards the bottom. Okay? All right. 1982-ish. Market bottoms. Again, even lower. See, we keep going lower and lower. And what happens? That's due to interest rates going down. But that's only after they were hiking it again. That Volcker had to. He had no choice. Yeah, what he did was he that was the first that was the first error that he had admitted to making. He let off too soon, and that's what Jay Powell, current chair, keeps alluding to. He goes, we cannot let off too soon, otherwise inflation will come back, forcing us to go even higher. That's exactly what happened. Here, then he let off, and then he's like, oh no, it got worse, and then he had to go even higher than before, right? Okay, so okay, so let's go to 1991, 92-ish. Market bottoms down here, and that's because they're already having to go down. In this case, they were holding, but then I think they were forced to, see, they were forced to go down. You had no choice because the markets were crashing. All right, now, 2000, oh yeah, .com. This is the .com. So I chose this zone because this was the official recession. The actual bottom was actually outside of the recession. Okay, outside of the recession. So, um, as you see here, what do we have? Interest rates are going down when the markets are bottoming, not going up. Okay, not going up. Okay, let's check out 2008. Well, we all know what happened here. In 2008, okay, so check this out. The Fed was actually trying to get ahead of it. They're increasing, and holding, but eventually they had to stop. They had to reduce it back down to zero. Markets were crashing. Okay? Markets were crashing. And 2020, likewise, it was the same thing. Actually, in this case, the Fed, before the COVID crash, actually was already holding, and they were already decreasing, and then they held again, but then ultimately they had to just go back down to zero. Markets were crashing. Okay? So that brings us to today. We are still tightening, guys, through February 2023, right? Everyone's talking about, well, the current rate is 3.75 to 4, but everyone's talking about actually there's a website that predicts the futures, actually futures. Um, that predicts the terminal rate to be 5%. 5. Okay, that's high, guys. That's high. I'm gonna show you what I mean by that, by these percentages that you're probably wondering, like, what is this all about? Okay, so we are still going up. We are not holding, and we're definitely not declining. Okay, so after what you've seen here today, since 1955, at no time has the market bottomed while the Fed is hiking. Okay, that is compelling evidence that we have not found a bottom. We have not. I think that the October 13th, 2022 bottom is a bottom. It is not the bottom. Okay? So there is almost 3/4 of a century of data that says, no, we are not at the bottom. We are not even close to the bottom. Okay? Right? We're not even close. We are still hiking. Okay? Hope that makes sense. Now, what's this? What's this? What's all this business with 20%, 10, 6, 5, 2, 5? There is a peculiar pattern that for each one of these recessions, right? This, the gray bars, recession, recession, recession. Effectively, each time a recession happens, we've only been able to increase rates to about half or 50% of the previous hike. Paul Volcker, 20%. Next time around, it's only 10%. Next time around, it's only about 6%. Okay, well, this time it's about 5%. Well, we'll just kind of put these together. But last time was 2.5%. This time was supposed to be 1.25%, if that's about half of that. But yet, oh no, we're at 3.75 to 4 already, and we're talking about going back up to 5. So this move that we're currently this tightening cycle that we're currently doing, you guys remember the last 3 have been 75, 75, 75. Okay, this tightening cycle has not actually. When I look back, down, see, down, 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 higher, lower highs. Well, I mean that's up, up, up. But we don't see a higher high here come down and then see a higher high again. So not in the history of, or at least from what I can see from the federal funds effective rate since 1955. That's as far back as it goes. If it went back further, I would do it. So I can say not since 1955 have we ever had a tightening cycle where the current tightening cycle is greater than the than the previous. This is the ascending side. I'm talking about we're on the descending side. See what I'm saying? Unless this is the ascending and this is the descending, and now we are starting a new ascending, right? That's possible. That's possible. So we went ascending, descending, now we're ascending again. And if that's the case, that's even worse for us. We're going to start a new ascending slide? Oh no. Uh-oh. See? So there you have it. Let me know what questions you have. So far I've shown you the total assets, mortgage-backed securities, and bond purchases, quantitative easing, thanks to former chair Ben Bernanke. And now I'm showing you here the interest rates hikes and the correlation to market bottoms since 1955. At no time have we ever been at bottom while we are still hiking. Okay. All right. Now, so I want to show you this slide. In December of last year, December 2021, I learned of Larry Williams through watching CNBC, of course. Jim Cramer, that's down here. Say Jim Cramer breaks down Larry Williams. So after December of last year, I chose to subscribe to Larry's forecast 2022. It's on his website right there. So this is where I'm citing my source. This is where I got it from. Okay. And I'm mentioning this because I want to show you something. On June 17th exactly of this year, as we all know, that was the market. That was, not anymore. I say that in the past tense. October 13th is the new low. On June 17th, Larry sends out an email. I got the email, and I'm showing you what was in the email, the bulletin. And first of all, Larry Williams. Let me back up. He's on stockcharts.com, and his name has high name recognition and all that stuff. So on June 17th, he sends out this email, and I just want to highlight what he says. Last 89 years, there have been 18 such signals. The vast majority were in 3 weeks of the ultimate low, and the last 4 was in a week of the low. He's basically trying to call the low. And on June 17th, he would have been right because that was the low. So he's just trying to show, well, I have my secret signal indicators. I have this secret signal. He doesn't ever share what that is. Yeah, my panic indicator gave a stock market buy signal, right? Amidst the gloom and doom, there's a chance for a boom. There is now hope. So he says 3 weeks of the ultimate low or 1 week of the ultimate low. In the last 89 years, his indicator has shown this. Here's what I now read with dismay. I believe we are in the process of starting a multi-year bull market. Now, so this is Larry Williams, the famous Larry Williams that he's talked about on CNBC right here. Seattle Kramer talking up Larry. So was this panic indicator right in the last 89 years? 3 weeks of the low? 1 week of the low? Was it right? Well, let's go have a look. That's June 17th. That's December 13th. You were 4 months away from the low. Were you right? Oh no, you were dead wrong. Okay? I'm trying to just point out that was way, way off. And you can't just rely on what somebody else says when they are just looking at. See, you notice by now when you watch my videos, you never hear me talk about price correlations and you know what I mean? You always hear me talk about the MACD, the RSI. I don't care about price, right? I only care about price relative to its EMA 50 line, right? You guys who listen to me, that's the extent I care about price. I don't care about um, you know price formations, rising wedges, falling wedges, rising channels, falling channels, because I look at the MACD to confirm whether um, whether a pattern is likely to occur. But unfortunately, these indicators that a lot of people like to use, including Larry Williams, it's just on price and statistics. And see, you notice for those of you who listen to my channel, I don't use statistics. I don't say things like, well, in the last 89 years, there have been 18 signals and three weeks, and the vast majority were within 3 weeks, and the last 4 within a week. Okay, that's statistics. That's like saying, well, you got an 85% chance of getting this call. It's like, no, I never say that. I don't give numbers and statistics, which is ironic because I took 3 semesters of statistics in college and I love statistics, mean, standard deviation, all that kind of stuff. So they were just wrong. And Kramer, you guys listen to Kramer, he was dead wrong too. He said, "Oh, that's the low. June's the low." And so now he's like, "Oh, maybe you guys should back off." So, okay, so what I'm trying to say here is you don't have to listen to me per se. I'm not saying you have to listen to me. You don't have to listen to me, but you don't have to listen to them either. Okay? That's all I'm trying to say because these guys, boy, I don't know, I mean, just flat out wrong. Okay? Flat out wrong. And look, still despite all that, 2 weeks ago on 11/15, yeah, almost 2 weeks ago on 11/15, he still gets on YouTube. The end is near. The end is near. But now it's like, no, I don't think the end is near. I think the opposite is true. This is the beginning of the end. Okay? This is the beginning of the end, not the end is near. All right? Based on what I had shown you in previous charts on the interest rates, right? It's hard to argue, oh, there's a bull market coming. Oh, really? Where do you see that at? Where do you see this? Right? If I showed you the quantitative tightening, right? You saw that downward curve and the markets are correspondingly going down with it. Where do you see a bull market coming? Right? Okay. So, so I showed you Larry Williams, but now I'm also going to show you the opposite, Gareth Soloway. Okay. Gareth is a good guy. He has, although he's actually like chief marketing strategist for a firm that invests in crypto, okay? Crypto and Bitcoin. He clearly has a bias for crypto and Bitcoin, but he can put those biases aside and he can call a spade a spade. So that's why I don't mind listening to him. For example, over the summertime, we all know in June, right around June 17th ish, we all know Bitcoin dropped to 17.177, 17.5 ish, right? It dropped, right? It was up at 60 at one time, 60K, dropped to 17.7. Even at that time in the summertime, because I was listening to Gareth speak on YouTube, even at that time he said, "Hey guys, I think Bitcoin is currently at 17.7 and it went back up to 20K." But even at that time, he kept saying, "No, I still think it's going to go down to 10K, right?" So he was still able to be objective, even though he has a bias for it. Okay? And now look what he says down here. This is 2 days ago. This is 2 days ago. He thinks Bitcoin is gonna hit 7. So he's actually decreased it from this is in light of the FTX bombshell, right? Everybody knows about that. So he thinks it's going to hit 7 by May of 2023. Okay, that's what he thinks. And also 2 days ago, he says this is the beginning of the end. No new highs for the S&P and Nasdaq for 15 years. Okay, I believe that to be true. If the Fed continues on its path of quantitative tightening, as you saw, the 95 billion per month, and hiking and holding interest rates at a high level, oh yeah, there's no way. There's no way S&P 500 or Nasdaq or the Dow will ever get back to new highs. There's no way because as you saw, the markets follow quantitative tightening, the QE, QT. They follow that and they follow interest rates. They don't move separately. They are not mutually exclusive of those things, right? Right? So there's no way. There's Gareth is right. The S&P 500 and the Nasdaq cannot hit new highs again. It can't. The financial conditions are not there. The math is not there. Okay. Now, I'm going to show you something else. So Gareth says by Bitcoin to hit 7K by May 2023. In the part one series of my nowhere near bottom, that is about in line with, and I'll put the slide up, I said March 2023. So, May is going to be somewhere, in this range. Okay? So, and also in that, also, let me go back to that slide. Also in this video, he says, we are about a year out. About a year from the low. That's what he says in that video from 2 days ago. Yeah, we're about a year out from the low. And that is about also in line with what I said. I said, August 2024, right? So, um, so very interesting, his positions on things. Now, in a previous video, I put this slide up. This is basically for the month of December of this year on EOY, end of year rally reasons. Okay, right? The fund manager bonuses, incentive funding right here. The stock buybacks, right? You've got accelerating Q4. Here we go, final month buybacks. You know, slowing rate rises, Fed rates. Now, 2 out of 3 of these will be absent in January. It's going to be reason 1 and reason 2. So I just took 2 out of 3 reasons why the market would want to rally. Okay? This is the only reason left. Slowing rate rises. That's the only reason left for the market to even have a chance of rallying in January, February. Okay? Now, having said that, because now I just took away reasons 1 and 2, right? The fund bonuses, right? And the share buybacks. I'm going to add another reason why it won't rally. So I took 1 and 2 away, but I'm going to add 1 back. Look at the layoffs. Big companies, right? Here's the initial jobless claims that came out this past week. Went up. This is only just beginning, guys. Okay, so we are now seeing in November the effects of the beginning rate hikes that started in March, April. You know how there's always like a 6 to 9 month lag of the impacts of the Fed's rate hike decisions and what happens in the economy. What I'm saying is we started off slow too. Remember in March it was only like 25 basis points. That's like, yeah, big whoop. Okay, then it went to like 50. But then the last 3 have been 75, 75, 75. We're going to start to see what's up with that 75, 75, 75 in March, April, May. So get ready. That's what I'm saying. We're going to find out. We're already finding out. We're already in November finding out what's going on with those much earlier in the springtime rate hikes that were small. They were very small. And then in a couple weeks, we're about to get another 50. Okay? We're about to get another 50. And then in February, we're going to get another 25. So there are too many headwinds. I don't see how I don't see on what basis any analyst on TV or whatnot can say we are now at the beginning stages of a secular bull run. You've probably heard that. I've heard that on the media. But yet we have all this information coming out a day ago, like right here on your screen. Well, that looks like a bull run when we're just laying off people and we're increasing interest rates still, right? And we're doing quantitative tightening, subtracting 90 billion monthly off the Fed balance sheet. They're not bailing out the companies anymore, guys. So, on what basis would you make a secular bull run argument from? I'm curious to know. Okay, maybe I'm missing a 900-pound gorilla that's right there in the room and I don't see it. But how can you make the bullish case? And I'm talking about macroscopically here. Okay, so um, that, my friends, are what I wanted to share with you today. Um, and if you like what you saw, but first you could follow me on Twitter if you want to get more up to date. I use intraday kind of tweets, especially if I see something big happening or something's about to happen. I'll tweet it out as fast as I can. Okay. And if you like the video today, please give it a like, share this with a friend or a fellow trader, subscribe, or click notify to be notified. And with that, here is my calling card. I am signing off. Agent 000. Talk to you again.